Hey guys, it's Colin again. I am doing another video all about the short strangle. I did do another video similar to this. I'm going to include the setup, how we set it up, how the Greeks work on it, specifically theta and vega. There will be some delta too, and management. So what happens if we get tested? What happens if, do we roll the untested side? Do we add? It's important to know when selling options, which is primarily what I do. If you have the capital available, there's always a move you can make if you do it early. So these are why we do these strangles about 30 to 45 days out. Sometimes 45 to 60 is probably a little more accurate for me. So this, you can see, is the January 15th, 21. It's about 53 days out. Now, what we're doing with the strangle, when we have the short put here and the short call here, is we are short premium, we're getting a credit, and we are selling volatility. When we're selling options and we don't have a long component, we want to sell when volatility or IV rank is high, and then buy it back cheaper. So with the short put right here, what I've been doing lately with this market that just seems to go nowhere with it up, and this is Tastyworks platform. This means 1 standard deviation. This means 2 to the downside, 1 standard deviation, and 2 to the upside. So what I'll do is I'll do the 1 standard deviation put. So let's say on NVIDIA, a stock I trade all the time, 435 put, and then the second standard deviation call, about the 715. Now, this will take about $5 grand in buying power. And so when do I want to sell these? I keep strangles on pretty much all the time, but I want to, in theory, sell it when volatility is high. When the ticker VIX, ticker VXX, ticker UVXY is up, like maybe $1 or so, at 5% roughly, you want to sell these. You can actually make a lot of money from the volatility contraction. What we do know about volatility, one of the few things we know that's concrete, is it's mean reverting, which means that when volatility spikes up, like in the sell-off in March, it will always come back to the mean. And it usually comes back, I think always comes back faster than how it goes up. It goes up, real quick. But then it comes down quick also. And you can make money off that. I think people think you can only make money off the delta, if it moves your way. I primarily make money off of vega, implied volatility crush, and then theta, which is time decay. For anyone that's confused, I'm going to go into the Greeks specifically right here. How theta works, this is this number right here. So on this strangle, each day I will get $25.24 roughly. Now that's going to increase at an increasing rate. Options expire, and there's only a certain amount of time it can go up, down, left, right, whatever. So as there's less time, there's less chance that it can go in any direction, which means there's less time value. So I love positive theta. This is how I make all my money, is by what we call selling premium. So the second one is delta, which is right here. So when you see something like a 6 delta, where it's going to round down to 6, what that means and what you should know are 2 things. One, that's 6 shares of NVIDIA long, or the equivalent if I bought 6 shares. But more importantly is my chance of touch is 2x. So, and I'm going to go into what that means. So on the delta, let's say it's 6, or it is in this case, the chance of touch is going to then be around 12 on each side. So 88% chance I don't get tested at all. I just keep all the premium. So what that means, you get tested if the strike is at 435 or on the call side 715, it will touch 715 or touch 435. So it's a 12% chance of that. Some people I learned from will sell like 20 delta strangles or 30 delta strangles, which are, let me show you what that is. I'll look really far in something that's going to look kind of like this. Let me see where we're at. 14 delta, something like this, 22 delta right here. And one thing to know with options, the closer they get in, so the call this way and the put this way, closer they are to the strike price, they burn more theta. The closer they are, so at the money is going to burn the most, or in the money, deep in the money, but no one's going to be trading that preferably. The reason I don't like to do that, even though you make more money, is let's say 25 delta. That's a 50% chance it's going to touch, and for me, 5 delta, 10 delta is about as much. Occasionally, I might go to 15 on a if there's not, if it's 2 weeks out or an earnings trade where there's less theta, but typically this is what I do. And when I say I'm selling volatility, what that actually means is, let me say how I said how volatility was measured. It's the VIX, or ticker VIX. And what I want to happen over time is, so let's say we had a big rally, and the stock goes from 525 to 550. It goes up 5%. I would make money on the put side, and since I am long delta, I want it to go up. So I'd make money on that. I would lose a little money on the call side, but I would make more on the put side to more than offset the call side, at least for this move. But also, so that's the delta component. The theta component, I'm making that $25 every day, so there's that. The vega component is when the markets rally and all indices are green, things like that, the vega just gets crushed. And that means if you sold before that, you make a lot on the vega crush. There was an NVIDIA trade last Thursday or last Friday, and I was pulling out dollars, which is $100 in the option world, in a couple hours, just from the vega crush. So it's a powerful thing, a lot more powerful than delta, in my opinion. It's a big part of the option pricing. So lastly, how do I close these, or how do I roll these? I went into gamma risk a little bit. Gamma risk is, one of the Greeks is gamma, it's the acceleration of delta. What you should know is that when this time right here gets to, let's say, January 5th or sooner, any move, up, down, whatever, there's going to be an overreacted gamma move, and the option price is going to go higher. Now, one thing that some people don't understand, if you buy options, which I really don't, then you want the price to go higher because you buy it and you sell it back higher. That's the game plan. What we do is we sell it and then buy it back lower. So anything where the option price is going higher is bad for us. And what I wanted to go into about its extrinsic value quickly. When you do a trade like this, there's 100% extrinsic value. See, the credit is 744 and the extrinsic value is 744. That means that there's no intrinsic value. And what extrinsic value is vega, so the volatility portion, and then theta, the time portion. So I want both of those to go to zero. Again, theta will always go to zero as options expire. So in closing these, I'm going to close these about 25%, so maybe around $2. Try to make a couple $100 per one lot. That's pretty easy. I don't really hold past that. Sometimes if it's up $100 in an hour, I'll just take it off. Always take profits and pull profits. It's never wrong to make money. So more importantly, what happens if I get tested? What you can do is, I'm just going to use the put side for an example. Let's say the stock goes to 450, so about 3% or so away from the put side. Immediately, every time when you get tested, the most important thing to do is to eliminate delta risk. So when the stock moves down here, this long delta, or the put delta, is going to get higher the more it goes down. So I would roll this call maybe from 715 to 615 and immediately cut my delta roughly in half. So that's step one. That's always what you can do real quickly. Typically, it won't keep going down. It may level off. One thing why I sell the 1 SD standard deviation strangle here and then the 2 SD on the call side, I'm always prepared to take the shares of this. And you have to take 100 shares. So this would be $43,500 or like 23 on margin, 50% on margin. And then I sell calls on that and get called out, and I will go. That's called the Wheel of Fortune. I won't go into that in another video. But that's how you manage it. I try to pick stocks that don't just fly around crazily for just that reason. Because if it goes from here to around the strike price, or even if it goes to 420, you still have things you can do. But if you have a stock that's at, let's say, 100 and it goes to 50 and your short strikes 80 on the put, you're going to have trouble with that. So volatility is good, but You don't want to be out of hand. One other thing I can do too, I was going to explain, and I'll let you guys go. We went over a long debit spread, a long put spread, which is also called a long debit spread. So what I'll do, and it's going to switch the screen here. I always pick the same expiration, but let's say I'm getting tested on the short side, and I was at 435. So what I'll do is I'm buying this because the long option is bigger than the short option, a long debit spread. This is going to cost me $63. Obviously, if it goes way down, it's going to cost me more. And since it's a $5 spread, you see 435 to 440, I pay $63. 63 minus 500 is $437. So if it keeps going down, I'll keep $437. And this is a great way to kind of hedge yourself, and you do it for free because the credit still outweighs this. So you could even do a 5 lot of this, and this is if you're really in trouble, really getting tested. Buy 4 of them or 5 of them. That way, you just get out even if it keeps going down or if it goes up. So that's what I would do. You can do it on the call side also with a long call vertical, a debit, which I went into the last video. Anyway, thank you guys. You will make money using this stuff. I promise you. And what I ask, I give this information out for free, is if you have a charity of your choice, give 1% of it to a charity. This is actionable information, and you will make money off it. Please let me know if you guys have any suggestions. Like the video. Thanks. Bye.